Let's talk about types of client. When we're talking about types of client, what are we talking about? We're talking about businesses. All right. And we're talking about liability. How about ease of formation? And we're talking a little bit about taxes. Okay, I have some information later in the unit about taxation on some of these corporations, but I'll give you a high level. All right, first and foremost, sole proprietorship. Okay, one individual. All income made by a sole proprietorship, okay, which is a type of business, is income of that individual. They are the simplest to set up. There's many benefits to, there's privacy benefits. It's an entity separate from yourself. However, they are unlimited in liability. Okay, so easy to set up. Unlimited liability. Okay, so you might get some tax deductions or things like that, but they're not generally looking for the tax advantages of a sole proprietorship. They're just looking for you to understand that it's one person, unlimited liability, simple to set up. Okay, wouldn't be good for raising capital. General partnerships. Okay, we've got two people that want to get together and they want to make a business. All right, how are they going to do that? Well, one way to do that is a general partnership. Okay, just like a sole proprietorship, it is easy to form, easy to dissolve. However, it has unlimited liability. Okay, it could be two or more individuals. Both people in a two-person general partnership would have full control of the company, but again, unlimited liability. One of the best things about the general partnership it would allow business profits and losses to flow directly through to the investors for tax purposes. All right. What this means is that in the case of a C Corp that we'll get to in a second, you get taxed at the business level, and then you get taxed at the individual level who's eventually receiving the dividends or things like that. Okay, but with a general partnership, it's going to flow directly through to the general partners. Again, unlimited liability. General partnerships can add limited partners. Okay, and then when they do that, it would be called a limited partnership. Limited partners have limited liability. Simple as that. Limited liability. While the general partners maintain control, they are the managers of the business. Limited partners have no control over the business. They are passive partners. The limited liability means that the limited partner can only lose what they put in. For our general partners and for our sole proprietors, they could, after you sue the business, then you could, sue the individual, and you could go after their house, you go after their car. Okay, so you could see some problems with that. But on the flip side, the general partners have all the control of the company, and the same thing with the sole proprietor. All right. The next thing, limited liability corporation. Okay, so this is a business structure that combines the benefits of limited liability with the tax advantages of a partnership, the flow through of taxable earnings. So no double taxation. Probably the biggest thing is, obviously it says it right in the title, limited liability. You can only sue the corporation. You can only sue the business entity. After you're done suing the corporation for everything it's worth, there's nothing else left to do. Okay, so it's kind of like a shield. And that is one of the biggest benefits of a limited liability corporation. And they're fairly easy to set up. They're very easy to set up. I operate under an LLC. Just some paperwork in your individual state. Some people have to pay. You have to get a business account, and you might have to get a lawyer for some things. But it wouldn't take too much time to set this up and get the tax deductions, and then get that limited liability. I think it's a great idea if you're going into the business. All right. S corporations. When you hear S corporation, I want you to think S corp, shares. S for shares. Okay. They are companies that distribute shares or ownership of the company. It can only be done to 100 shareholders. This is the question that will probably show up if you get something about S corp. Limited to 100 shareholders, but profits and losses are passed through directly to the shareholders in proportion to their ownership. Okay, so you could own 80% of the shares, you get 80% of the profits or losses. This allows for the changing of ownership, the splitting of ownership really easily. You get some benefits of limited liability, much like the LLC, but it's going to allow you to, like I said, it's going to be able to have a fluid ownership structure. All the benefits of flow through taxes, okay? Last but not least is C Corp. C Corps are going to be the apples, right? They're going to be the Apples, they're going to be the Googles, okay? They're basically everything on the S&P 500, right? Everything on the S&P 500 is going to be a C Corp. Now, they have shares, just like an S Corp, and they have ownership, just like an S Corp, but there is double taxation with a C corporation. Okay, double taxation. Here's the illustration of it. Here, let me move my head to the other side. Okay, double taxation is when the business makes money, and the government says, "Okay, give me that money." Okay, so 1 times tax. And then the corporation says, okay, I want to give a dividend or a return of capital to my shareholders or my owners. And so they send a dividend to the shareholders. The shareholders say, great, I've got a dividend. The government says, hey, I want a piece of that income. Okay, you've got to consider that income. And so that's it. That's where you get your second round of taxes. That's only with a C corporation. C corps are great for raising large amounts of money. Okay, and these are the big boys. Okay, S corps would generally just be like a small family business. LLCs can vary in all different sizes, but they would be decent for raising capital. But they're generally going to be looking for is the limited liability. Limited liability partners, again, they can only lose what they put in. That's what it's limited to. They have no control of the business. General partners control the business. General partnerships are easy to form, easy to dissolve, but unlimited liability. And sole proprietors, it's just going to be one individual. Easy to set up, like dangerously easy to set up, just probably a couple forms and a small fee, and then you're going to get some business deductions that would help you out. Okay. All right. Let's